What we want to kind of talk about here for a minute is where we've been, what we've gone through, and where we're still seeing the issues relative to inflation. If you look at the left side, you go all the way back to January of 2021, we were comfortable at a very low 1.4% inflation rate. Been there for quite a while, right? It's been pretty calm, on the inflation front leading into 2021. But look what happened. Didn't take long and inflation really started getting bad about end of 2021. Then going into 2022, look at that. We hit 9.1% year over year inflation. The good news is the Fed raised interest rates, tightened credit, made it more difficult to borrow, and we've actually brought it down to about 4%. So inflation is coming down. The Fed's target is still 2%. I think this last couple percent is going to be very difficult to achieve. In fact, I wouldn't be surprised if it sticks closer to 3%. When you look at the components, what's making up, where's the inflation coming from? If you look at the green bars, the tops of each of these bars, the green, that represents energy. And you can see back in May of 2022 how large the energy portion was contributing to overall inflation. Well, look what's happened over time. How that green bar has shrunk to the point that it's actually been negative. It's been deflating. So energy has been a big reason we've gone from 9% to 4%. The energy cost inflation has been going down. Then we look at this side of what's going on in the economy. This may be the most widely anticipated recession in history. We've been talking about this since the beginning of last year. It's coming, it's coming, it's coming. We're still not quite there. We've been able to do things to kind of push it off, to lessen the financial impacts. What's really interesting here is when you look at two things: personal household debt and the ability for companies to pay interest on their outstanding debt. Okay? Here's where we're at right now. 9.7% of disposable income against debt is lower than in past recessions for the consumer. Look where we were in 2008. The consumer was highly in debt and we went into recession. What happens if you have no money and you get laid off? A little different than if you had a few bucks in your pocket and could ride it out for a while, right? Well, that's what's different today than in the past. Consumers are in better position. What about companies? Companies are in better position too. They're at a 13x ability to pay the interest on their outstanding current debt. Look at where they were in the past. Look what's happened to their ability to pay. Okay? You know what's caused a lot of this? We talked about inflation is coming, Fed's going to raise interest rates. Everybody got their house in order. You went out and borrowed money before the rates went up. Same thing with companies. They restructured their debt for lower interest rates for longer periods of time. So if you went out and bought a house 3 years ago and you're paying 3% on your mortgage, does it matter to you if it's at 6% today? No. You're not going to refinance. Reasons we're thinking that this recession can be very mild and we can get through this. The consumer's in a better position. Companies are in a better position.